Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of Cherry Beckert Tax Beat podcast. Today we're talking about certain U.S. tax systems and how they may be similar or may differ from those of another country. International companies are introducing their goods and services into the U.S. market, expanding operations, and investing in capital and production. For companies that are new to the U.S. or have been here for a while, it is valuable to get a picture of the tax compliance rules that can frustrate even the most experienced U.S. company. Joining in today's conversation is Lauren Stinson, partner and leader of our sales and use tax practice, and Brian Dill, partner and leader of our firm's international tax services team. So, hello, Lauren. How are you doing today?
I'm good. How are you, Rex?
All right. And this is a very apropos discussion. You're leaving for India. When and for how long?
I'm leaving at the end of the week for 3 weeks. So very excited to talk to all sorts of different Indian companies about doing business in the U.S. and all their sales tax obligations.
Right. And Brian, how are you doing today?
Great, Brooks. Good to be here.
And where are you sitting at this moment in time, Brian?
Sitting in Atlanta. I'm here in the States.
All right. And not in India. You're not in India for 3 weeks. All right. And as always, joining me, Sarah McGregor from our Greenville office. How's life treating you, Miss McGregor?
Life is good. I'm not an app yet, but if AI keeps going, maybe I'll become an app someday.
All right. Well, you should be getting excited. We're getting close to our March 15th deadline, which means we're getting close to having March 15th deadline behind us. So if you want to look at it that way. All righty. And I guess I should say I'm Brooks Nelson sitting in here in Richmond today. And it's a kind of dreary day in Richmond, but not too cold at least. All right, so let's move on for a little background. An international company making a step, small or large, into the U.S. market has a few key tax systems to learn and adapt to. First among these is U.S. sales tax. Many other countries offer their version or their pseudo version of sales tax, be it a value add tax, VAT, or, for example, in India, apropos, a goods and service tax, also called a GST. The U.S. sales tax is very different in who pays, who collects, and at what point in the economic transaction. International businesses and U.S. businesses find it challenging to understand where, when, how, all these issues with sales tax to collect, and not to mention the systems for doing so. Foreign tax compliance rules offer similar challenges regarding withholding of payments and income to foreign owners. And anyway, as you can all, unfortunately, none of all these, these jurisdictions don't want to get together and just do it one way. And I guess what's, the pros and cons, the winners and losers to each system. So everybody kind of wants to do what's best for them. And that leaves our poor taxpayers in desperate need for our expert tax advice and services that we have to provide. So we'll start with Lauren, sales and use tax. Give us an overview of the key differences between VAT or GST and the U.S. sales tax in 30 words or less, please.
30 words or less. So one of the biggest differences is the taxation structure. In a VAT or GST regime, everyone pays the tax all along the supply chain to the buyer and then collects the tax when they sell the product. And then when they file the tax return, they net what they collect and they paid, and the difference gets paid on the tax return. However, with U.S. sales tax, resale exemptions or resale certificates are used by every buyer in the supply chain, and only the final consumer pays tax at the end. So in both cases, the burden of tax falls on the end user, but the mechanism of how it works is vastly different. So the other big differences really revolves around rates and jurisdictions. In VAT and GST, there are typically just a few uniform rates and not that many different taxing jurisdictions. Whereas in the US, there's over 13,000 different jurisdictions, all with their own rates. So I know that was more than 30 words, but I want to do justice just to show how different they are.
That was a very concise description, though. Thank you.
So how does the actual compliance, like the paying and reporting, differ between the VAT and a GST or the U.S. sales tax?
It really boils down to the compliance. So in the U.S., taxes based on a couple key concepts: nexus and taxability, and a combination of having sales tax and selling taxable goods and services. That's where sales tax needs to be collected, versus collecting it along the way in every transaction for a foreign, in a foreign country.
And you alluded to this earlier, but and Brooks alluded to it as well. Every location in the U.S. has a different rate. Is that similar in other countries, or is it just us where you've got these hundreds of locations you've got to collect and report?
We like to keep things pretty complicated. So in the U.S., there's 13,000 different sales tax rates amongst the whole country. We're dealing with 50 states. It's almost like 50 countries. Whereas most countries keep it a lot simpler with just, one or two, a few number of tax rates.
All right, so let's revisit these themes that you talked about. The first one being taxability. What gets taxed in this?
So generally across the board in every state, most sales of tangible personal property get taxed, and some states tax a fair number of services. So not every service, and certainly that varies quite a bit across the different states. So you've got taxability of products and services, and then depending on the nature of the service.
And so how does a company know that they have to start collecting sales tax? What are the triggers there to create the situation they're subject to it?
Well, that's the $1 million question, and one that we help clients with all the time. It really boils down to their Nexus footprint, meaning where do they have a connection with that state, and that connection can be created from being physically present in a state, meaning they have employees or sales reps or offices or inventory, any physical connection to a state, and it can even be subcontractors or 1099 employees. So that's the concept of physical nexus. There's also the concept of economic nexus, meaning you're selling enough into the state. And of course, being the complex country that we are, enough is defined differently in every state. So kind of a good rule of thumb is if economic nexus is triggered if you're selling $100,000 of sales to customers in that particular state. So again, it varies somewhat from state to state, but that's a good benchmark. So either combination, physical nexus or economic nexus, will create potential sales tax obligations if what you're selling is subject to tax.
And so, Brian, thinking about those same rules of economic activity in a state or a physical presence in the state, is that the same rules that would cause a company to be subject to federal income tax and federal reporting?
Well, Sarah, we would not be having this conversation today if it were the same, correct?
Right.
So the answer is no. I would say on the physical presence, while there are substantial differences between federal and various states, there is a running theme. So if you have physical presence, you should evaluate whether or not you have a federal reporting or liability perspective here in the United States. And that means whether you have inventory in a state, you own a building, you have employees, the general things that you would also run across from a state perspective. I think it's when we get to the economic case that it differs. We have a different situation here on the federal side in that from an economic nexus, we also have what we call source rules, and I'll get into that in a second. And that was really expanded, I think, I don't know how long ago, if you all remember Toys R Us and the Jeffrey case that expanded economic nexus to where the use of intangible property inside of a particular state, you could have economic nexus. And I think Sarah was right there in your home state of South Carolina where that occurred.
Absolutely.
We replace that with withholding taxes because we still say the source of the income is U.S. source, but you don't have a reporting obligation. Instead, the person paying it has a withholding responsibility from that perspective. Now, the Wayfair concept, the simple fact that you're selling into the United States, most of the time, we have not gone that far from a federal perspective and said that you have a federal reporting and or liability perspective.
So it's a little bit different. A company that is selling into the U.S. from abroad, but doesn't have a physical presence here, may be required to be paying sales tax, but might not yet be reached a situation where they have a federal income tax.
That is correct, Sarah. The only thing I would say is you need to be careful in the federal context of knowing what your legal contract is. I think a lot of times in the e-commerce environment, people say, well, we're using the Amazon platform, for example, and we don't have any presence in the United States. Well, it may be on consignment so that the inventory is being held in side of the United States, and that foreign person actually still owns inventory here in the U.S. And for those foreign companies that do not have a treaty with the U.S., that very well could raise to the level of a trade or business and physical presence. So,
Brian, we got March 15th looming, as we were talking about earlier. That's an important deadline for many things in our tax system, including paying certain withholding taxes. So what should international companies know or do regarding a March 15th potential deadline for withholding taxes?
So if they have a couple of things, if there was U.S. source income and there was a withholding tax remitted, they should be receiving a 1042-S, and they should evaluate that 1042-S to see if they were over withheld and may have a refund opportunity. For the withholding agent, it's important to understand that most likely the time to pay has already passed, and they should do everything possible to get their payments in and mitigate the penalties and interest on that, because that usually withholding taxes need to be paid usually within 2 weeks or a month of when you actually make the payment. The form needs to be filed by March 15th. And this is one of the unusual circumstances. People say, well, can I get an extension? The answer is yes, but it's only a 30-day extension. It's not the usual 6-month extension that people are used to. So it is a very narrow window to which you can get an extension.
So this is more like it was sort of just a summary of what has happened, all the payments that were made and withholding made over the last year. This isn't where a company now initiates withholding and paying in those taxes if they've done it right.
That train has left the station, so to speak, Sarah. Yeah. But if they do, get the payments in immediately and toll the interest and the penalties is our recommendation.
Right. And I did see in the tax news recently, the IRS has backed off of the requirement for electronic filing of these forms. They will allow companies to mail in forms if need be for this year, but that's going to be a hard requirement coming soon.
Yeah, 1042s that's the form you file for withholding taxes. Those were to move to the electronic system, but the IRS did issue a notice and has delayed that implementation.
Great. So for U.S. subsidiaries or branches of a foreign parent or foreign owners, what should the accounting or tax teams be talking about with these owners right now here in the early part of 2024?
I think a couple, 3 things they should be talking about diligently. One is what are the overhead allocations, what costs are going to be contributed to the U.S. company that they're going to have to bear, making sure those are all trued up. What's the intercompany pricing look like? Especially for branches, people can be a little lax in what the remittances look like. You know, that they took money back to the foreign parent, and all of a sudden they want to say that's a loan. Well, is that really a loan? Is that possible? Do they have the documentation in place, or did they have a dividend distribution? And do they know, right? Was it a dividend, or do they have sufficient earnings to make a dividend distribution? And if it was a dividend, were there withholding taxes, and should we have paid withholding tax and done those things? So all of those things can be a little, let's say, sloppy because it's all intra-company, so to speak. We're all part of the same family. Should be talking about those things and stratifying them and getting them to the right buckets, so to speak, at this time of year.
So anytime payments are crossing a border, then we should be paying more attention to that payment and what it is and what should be done about it.
I would say, Sarah, you know, in my area, if there is any area that has had more financial statement restatements, it's the intercompany accounts, because we'll book it to the intercompany. We'll book it to the intercompany, and it's this spider web and trying to unravel what has occurred over the last year of all the intercompany transactions, because people didn't take time to close the books on a quarterly or a monthly basis. And here you are, March 4th, you know, trying to figure all that out.
Yeah. So, Lauren, you mentioned 13,000 jurisdictions for sales and use tax. I'm sure there must be some technology or outsourcing solutions to help companies with this that would help a U.S. based company as well as an international company.
Absolutely. There's too many tax rates and different tax abilities to try and do this manually anymore. So there are a number of tax engines that will bolt onto either a billing system or an accounting system, or if it's an online company, bolt onto the shopping cart. So then when somebody puts in their address and it's a specific type of product, then the tax automation engine can go up into the cloud, look at the product tax code, look at the rooftop rate of the address, and then come back with the appropriate sales tax rate. So that's the best way to handle it, is using some sort of tax automation system. And then as far as compliance, there's a number of outsourced providers. Of course, Cherry Becker is one where we handle all the filings for companies, handling all the notices, and really making sure that the tax automation and the tax technology is working correctly to get the right rates. And then we ensure that the returns are filed on a timely manner and accurately, as well.
Brian, what are your thoughts on automation and technology of outsourcing tax solutions?
Well, I think a couple of comments there. Number one, when you're dealing with cross-border, setting up your ERP systems correctly and getting the correct advice with people that know how to set up those ERP systems. A lot of times we see, our U.S. branch of our foreign company are in the same company. Well, why didn't you set it up in a separate company under the ERP system so you're able to track the intercompany accounts? And then what are your digital solutions for intercompany pricing? Are you using transfer pricing that has, like we do, to support it, that uses something like a Reptune, a digital software, to help you comply with various jurisdictions?
All right. Well, that's been some excellent conversation. And so let's move into final comments. And Lauren, you have the floor first.
Sure. So, sales tax is very complicated, and the the thing about sales tax that I want every company to remember is that it should not be a tax that your company needs to pay. If you've got obligations to collect and file sales tax, you should be collecting it from your customers and paying it to the state government. So it really shouldn't be coming out of your own pocket, so to speak. However, if you are not doing it correctly, now all of a sudden you go from being a tax collector to being a taxpayer, where you have to pay all of this tax out of your own pockets to the state Department of Revenue. So it's really essential that you take the time to understand what your obligations are, understand the taxability of your product and services, set up tax technology or processes in place to ensure that you are collecting all 13,000 sales tax rates correctly, and then a process or an outsourced solution to get all your returns filed.
Thank you. Brian.
So I would say, Brooks, that anytime a company is looking at expanding into the U.S. market, realize that you have 4 different layers here to evaluate. You've got state sales and use tax for all 50 states and the localities, the sub-localities, and that has its own rules, its own independent state rules. Then you have, like Lauren said, state income tax, direct tax. But then you have the federal rules and what federal direct tax is. Do you have a presence here? Do you have a taxable business? And that is all governed by federal tax laws. And then you may have treaty overrides. And what are those treaties and how do you access those treaties and what do you have to file and complete here in the United States? So it's something that should be done up front as opposed to once you've been here a year and say, I need to file a tax return and it's March. That could be a little too late to take full advantage of opportunities.
All right. Thanks, Brian. Sarah?
No, I think both Brian and Lauren have hit it, that there are a number of things which, if handled correctly on the setup and up front and given attention, will be less burdensome. But coming in, as Brian mentioned, at the back end or late and trying to clean up, now you're on your back foot for a number of periods trying to get caught up with it, and at the same time you're trying to grow the business and expand in the location. It seems like it ought to be the last item on the list, but until you start getting those notices and that attention from the governments for their taxes, then it becomes a front burner issue, and it really needs to be can be lessened by paying attention to it early on.
For my part, I continue to be struck by how much more complicated our world economy gets, and the associated compliance with it continues to get more complicated as well. And as various jurisdictions want more budget dollars, as they're pressed for budget dollars, I mean, they're getting more and more assertive about their rights to grab these taxes. And, as everybody's made the point, if you're on top of it, it can be relatively painless. Getting behind it becomes problematic. And particularly in the withholding tax scenarios, the penalties can be very excessive. And it's it is definitely in your best interest to consult with the proper people when you are getting into the business of coming into America for the first time. So we still welcome your business, however, just to be clear. All right, that's a wrap on today's discussion on tax reporting complexities for international companies when they're starting to do business in the U.S. Quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Lauren. Thank you, Brian. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.